Hey team, and welcome all you fans of financial freedom. So if you are between the ages of 45 and 75 and you're worrying about retirement and how you're going to fund it and live the retirement of your dreams, this video is for you because we're entering the retirement red zone. But everything you've ever been taught about asset allocation and diversification is wrong. Now guys, I'm really concerned that people are not paying enough attention to their 401ks and their retirement accounts. I want to draw attention specifically to what's happening in the markets and especially with Warren Buffett, the Oracle of Omaha. He is selling like crazy. And I don't even know if he's done yet. I think he sees that the market is overvalued because he's got $325 billion of cash in his war chest. It's unbelievable, right?
Right.
That is so much cash. Something's up and it causes me some concern. And I want you to be aware of what's going on. And I want you to look at your 401ks and retirement accounts and look at rebalancing your portfolio if you haven't done it in a while.
So in this video, we're going to look at how you can protect and grow your retirement money. I think that asset allocation is being done all wrong and your retirement is at risk.
That's right. It's time that we get this right. The stakes are too high. So let's fix this right now before it's too late.
So huddle up team, we hope you are all doing great. And if you're new here, we are John and Tara Thornman, your financial success coaches. Most of us are not taught what we really need to know about money, investing, and creating wealth. So we are here to help by teaching and training and coaching you how to achieve financial freedom faster so you can enjoy it longer.
That's right. Are you ready? So we're going to tackle this topic right after you crush that like button and subscribe to the channel because we don't want you to miss a single video.
Right.
All right, so actually, guys, the oldest advice on asset allocation is found in the Bible. Yep, you can look it up, Ecclesiastes 11, verse 2, and it says, invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land. Some wise advice right there, okay? And I love it because it's not just the numerical value of 7 and 8, but there's a deeper meaning behind those numbers, specifically in the Hebrew language and the culture,
Right.
which is about completeness. And anyway, I just love it. So you can dig into that, but we can look at the number. And 7 and 8 is a great place to look at asset allocation that are non-correlated. And if you listen to Ray Dalio at all, he suggests 10 to 15 non-correlated asset classes.
Right.
So we want to put our money in other asset classes that are not the typical conventional Wall
Right.
Street stocks, bonds, and cash. We want other asset classes to round that out to further protect you. All right, so take a look at this graphic because in your financial game plan, I've broken it down into 4 stages.
Right.
You've got asset accumulation stage, asset protection, decumulation, and then transfer. And to win your money game, you got to play each quarter differently.
Right.
There's different rules that apply, and it depends too on how old you are when you get to that stage and whether you're ahead or behind on your game plan. Now, during your early years, of course, that's when we're in our asset accumulation phase. We've got to invest and create and grow assets. During this stage, you want to be more concentrated, right? And put all of your investing money and effort and energy into your best assets.
Like Andrew Carnegie says, the way to become rich is to put all your eggs in one basket and then watch that basket.
That's right. That's not conventional wisdom, is it? Right? Everybody says don't put all your eggs in one basket.
Right.
But if you want to get rich, you need to be more concentrated. And that's the wisdom from Andrew Carnegie, who was once the world's wealthiest man. So diversification is not the objective early on in asset accumulation. We want concentration. Hey everybody, I hope you're enjoying the video. I just want to take a second and encourage you to schedule your free 30-minute discovery call with us. We want to encourage you to get your very own personalized financial game plan put together so that you're getting the right asset allocation to guarantee you the best outcome in retirement. And like I said, this is a complimentary. Click on the link below. It's in the description box, but schedule your 30-minute call so we can go over your options and put you on the pathway to financial freedom. Now, we're back to the video. As we go into the second phase or the second stage of your financial game plan, we come to asset protection. And there's an interesting transition here because we're entering the retirement red zone. Okay, that's the danger zone.
And that's what we're targeting today.
Right.
Okay.
That's what we're talking about here, the red zone, the danger zone. It's the 5 to 10 years before your targeted retirement date and the 5 to 10 years immediately after you retire. Now, in this asset protection phase, what we're looking to do is to begin diversifying. We want to reduce our risk, we want to reduce our volatility, and eliminate market risk and potential losses, because frankly, you can't afford to lose your retirement money right before you need to start drawing from it.
Right.
So when you're in the red zone, you have to score, right? So that's what we're talking about here, is you scoring with your retirement money. You can't miss, you can't lose money during retirement. And the reason why is because you don't have the time to make it back.
That's right.
You can't afford to try to recover some significant losses by having your asset allocation wrong. And so many people, your 401ks are at 80, 90, and 100% in equities, and you're ready to retire in a few years. You are at a humongous risk financially. So asset allocation and diversification are really the best ways to protect your nest egg. But everything you've ever been taught about asset allocation and diversification is wrong. Okay, it's wrong for retirement. It's wrong for individual retirees, and we're going to take a look at it. So, and this is especially important to consider as well. What gets you rich doesn't keep you rich. What gets you to retirement is not going to get you through retirement. We got to use this protection phase to change up our asset allocation models and start protecting the money that we have to rely on, that we can't go without, that we can't lose. This is really interesting. It's not that the popular retirement asset allocation models don't work well for retirees in some situations, but it's the fact that they can't work well for retirees in all situations. And here's why. Our asset allocation models coming out of Wall Street are built upon the modern portfolio theory that was put forth by Harry Markowitz in 1952. Okay. That's a long time ago. It's not so modern anymore, okay? But that won him a Nobel Prize in economics at the time. Wall Street grabbed his modern portfolio theory, embraced it, and they have been running with it ever since. And basically the idea is, how can I minimize my risk while I'm maximizing my rate of return by having a blended portfolio, not focusing on the individual stock, but having a blended portfolio of stocks, bonds, and cash. Here's why this can never work for you as a retiree to best manage your asset allocation of retirement money. You ready for this? It was never built for you, right? Markowitz designed this for institutional investors, for the guys on Wall Street that are managing your money, that have got an unlimited time frame and consistent cash flow coming in. This is for mutual funds, okay? Not for individuals. Individuals don't have an unlimited time frame. They don't have consistent cash flow coming in. They're retired. Their cash flow coming in stopped, right? Now they have to decumulate. They have to sell their shares and live on the proceeds. Completely different. Right. Markowitz is quoted himself as saying, "The investing institution I had most in mind when developing portfolio theory for my dissertation was the open-end investment company, or what we know as a mutual fund." So modern portfolio theory that Wall Street has run with, that we use every day to build client investment portfolios, is not for clients. It's for the mutual fund managers running an open-end investment company, a mutual fund. So it doesn't work for individuals. What this does is it locks you out from all kinds of other asset classes that would benefit the individual that the institution can't use, right? The institutions can't use annuities. The institutions can't use cash value life insurance. The institutions largely are not using gold and silver and commodities and all this. They're using stocks, bonds, and cash. So as an individual investor, you're being cut off from all these other asset classes that are non-correlated to stocks and bonds that could help you protect and grow your money in retirement. But mostly that could deliver consistent, predictable cash flow. You got to replace your paycheck. And that's what these other asset classes can help you do. Wall Street does not advise you on all these other asset classes. They're in business to sell you stocks, bonds, and mutual funds and ETFs. And so that's how they are constructing their asset allocation models and building your retirement portfolio. But that's not designed for income. It's designed for accumulation. That's what they're really good at, is how to accumulate the assets. And all those entering retirement that are looking at income are sadly at a loss. They're not getting the advice they need. So the holy grail of investing, okay, if you look at Ray Dalio, is to have these diverse asset allocations that are non-correlated to the stock market. So Ernst & Young did a research report on this and published it like 2 years ago. And they looked at retirees and generating consistent income. And what are the best allocation models, okay? And what they found was that if you use 40% equities, 30% in cash value life insurance, and 30% in deferred income annuities, you would get the maximum amount of income and the maximum amount of money left over for your legacy, for your heirs, and not have to worry about money in retirement. Well, you're not going to hear Wall Street tell you that, right? And I'm not saying that that's the ideal portfolio for you either, because there's other asset classes.
Right.
And especially if you use self-directed 401ks or self-directed IRAs, you can include gold and silver and real estate and local small businesses. I mean, the universe, the asset allocation universe is enormous once you get outside of Wall Street and look at all the other opportunities. So most retirees are going to be better served by including these alternative assets and look beyond Wall Street. It'll give you higher distributions. It actually will require dramatically less capital in order to generate the same amount of cash flow. Some economists will suggest that your $1 million portfolio, you follow Wall Street's 3 to 4%, rule, versus an annuity, you could get the same amount of income with 40 to 50% less capital. So now you've got a guaranteed monthly income check and money left over that you can invest more aggressively to grow over the 20 or 30 years of your retirement in order to build that back up, in order to outpace inflation. So guys, I'm concerned with where we're at in the stock market, in our economic cycle. I see way too many people in the retirement red zone that are way overweighted on equities, and they're at great risk of loss that they can't make up. So I want to encourage you, if you've not done a portfolio review, schedule one, and we can be your financial coaches and help you with this. If you have not looked at how you can maximize your income with the least amount of assets, let's look at that. Call us up. We are here as a coach. We want to help you take advantage of all of the asset classes that would best benefit you so that you can live the retirement of your dreams.
Very good, hon. Good job.
All right, everybody. See you on the next video.